Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from US Tax Reform 2.0 to the OECD's latest developments. I'm Doug McHoney, PwC's US International Tax Services leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're back in our Washington, D.C. Policy on Demand studio, where I'm excited to have Calum Dewar back on the podcast. Calum is an international tax partner in PwC's Washington National Tax Services Office and the leader of our integrated global structuring practice, heading our outbound, inbound, and value chain transformation teams. Calum spent the first 20 plus years of his career working in the UK. Calum, welcome back to the podcast.
Good morning, Doug.
So Calum, on March 22nd, 2022, the OECD released commentary and illustrative examples to the Pillar 2 model rules that were previously released on December 20th. I'd encourage listeners that haven't already to listen to our prior podcast where we discuss these model rules. Listeners should also be mindful that the model rules and commentary are the first two of three expected sets of guidance. The third will be the implementation framework, which will cover administrative, compliance, and coordination issues relating to the model rules. So before we begin, Calum, can you try to put in context how big of a change Pillar 2 would be to our global tax system?
Yeah, I can try. I think it's, as we've worked through the documentation the OECD have released, and it's taken time. I keep saying that we're taking clients and companies through the 7 stages of grief. As you get into the detail, you realize that it's just a huge change and a huge compliance burden for most of our clients. It's setting up a whole new set of separate books, Pillar 2 tax books, with a bunch of concepts that no one's really thought about before, and are proving challenging for our clients. Partly because some of the wording is a little bit ambiguous and we're trying to work out whether it means X or Y, and that obviously provides some confusion until we know what it is. But also mainly because this is a whole new framework for determining a tax base. It's not financial statements. It starts off with financial statements, but it's not financial statements. It's not clearly defined tax rules. In the US, you've got code and regs that tell you how to determine the tax burden. Here we've got 70 pages of rules with 230 pages of commentary, which doesn't go anywhere near the same level of detail that code and regs do. And that's the challenge for most people, is reading this and saying, well, if that sentence means this, what do I have to do to make sure the calculation complies with that sentence? And it's a big ask.
It's a huge ask, and so I'll unpack that just a little bit. So the first point on the front end, like the data that's needed for these calculations, is going to be a huge lift. I think one of the things that I've learned as part of this process is that the rules appear to be more designed for IFRS type taxpayers than US GAAP, and particularly trying to get separate entity US GAAP financials is going to be a lift for big US multinationals.
Yeah, I'm not sure that the data requirement is different under IFRS and US GAAP, but US GAAP is different than IFRS, and US multinationals, probably more than other multinationals, don't necessarily keep books and records at each individual entity level,
right,
based on the US GAAP. They base them on management reporting. Sometimes they report up by segment. Everything gets done at the consolidated level. US MNCs are more about topside adjustments, consolidation adjustments, than maybe the rest of the world is. And so breaking that back down to each individual constituent entity is a big challenge. But I think that's true for the foreign multinationals as well. The difference is that US GAAP is more prescriptive in certain areas than IFRS is. So you are faced with the US GAAP answer says this, and the model rules says this, and somehow you've got to combine the two to come up with an answer.
Well, and I think certainly, I'm happy to speak for you on this. It has been a big education for us learning some of these US GAAP rules. And we've had to be reminded by some of our tax accountants that frankly, this isn't necessarily tax accounting, this is accounting that many of us as tax advisors are going to have to learn to understand the implications of these rules.
Well, certainly that I found that deeply disturbing. I mean, I thought I'd managed to get through my career without understanding GAAP. And then with 3 years to go, the OECD made me have to learn US GAAP, which is disturbing,
right,
to say the least.
And your point on the details being kind of sparse at this point and just being a framework, and we're used to, we have codes and regulations here in the US that until we actually see the legislation from to any jurisdictions that'll implement this, it does make it very hard to advise on particular transactions.
Right, and you've got to compare it to, I mean, you're too young and I'm almost too young, but go back to the 86 US changes.
I was not practicing that, for the record.
Those changes came in, and there was a consultation process. It took 2 years to frame that change in the legislation, with input from companies, advisors, government, etc. And then it took a long period of time to produce the effective regulations that made that legislation operable. Meanwhile, we've had something dropped with almost no consultation,
right?
And we're trying to interpret it, on the fly, with a very, very short timetable before this thing could become effective.
Right.
We can debate when it will become effective, but at some point it will become effective, and we are on a very short time frame to work out how you deal with these rules.
Right, and this appears to be a common theme now. We saw this in the U.S. with the TCJA, kind of a very similar tight time frame. We'll see what happens with the Build Back Better. We're increasingly short timelines with even more increasingly complex potential changes.
Right, and you see it, even with TCJA. I mean, the recent decision regarding the 245 Cap A in the period where there was no effective legislation.
The Liberty Global case you're referring to.
is an example of, because it was not coordinated and implemented in a seamless fashion, you're left with massive uncertainty, and now, that taxpayer and other taxpayers are trying to interpret a decision, 5 years after the law was passed, and how it affects you. And I think we're going to be very much in the same position with Pillar 2, the way it's going.
It's a great point, an important lesson, I think, that can be learned from policymakers. Kind of the third piece, which we'll come back to here in the podcast as we think about how revolutionary of a change is what does this mean to tax treaties? So I don't want to wind you up on that yet, but we'll come back to that, because I think there are a lot of uncertainties in that area and how that potentially impacts the Pillar 2 implementation. So let's dive into some elements of the commentary. First thing I wanted to talk about is when the undertax payment rule, which we'll refer to as the UTPR, was originally introduced, it established the need for a connection and or a transaction, thus the name undertax payment, right, between the payor and the low tax country. Did we get any clarity on that?
Well, we got clarity. There is no need for a connection or a payment. The way the rule is now framed is pretty much it's a soak-up provision that says, if the top-up tax that's being calculated is not collected through one of the other mechanisms that are in the provisions, then ultimately it falls back on every jurisdiction that implements these rules to collect that top-up tax through the UTPR, the undertaxed payment profit. It's interesting, I mean, in the OECD language, the definition has never changed. It's still the UTPR with no explanation of what the P means. It's only in things like the UK consultative document that suddenly magically payment turned to profit, but nowhere else is it actually in the OECD papers at all.
And I think we also saw it in the Green Book, where
they picked that up as well.
Right.
But no explanation from the OECD of this change at all. I mean, I think the way you've got to think about it is you've got a multinational group. There is provision in there that the top-up tax be collected through a bunch of different mechanisms, whether that's the IIR or the qualified domestic minimum top-up tax. But if nothing else picks it up, the UTPR is the fallback position, and it's merely an allocation of the tax that's meant to be collected amongst all the jurisdictions in the group that have implemented the rules irrespective of any connectivity at all. And that's odd in a multinational enterprise situation where there's no connectivity. Imagine those companies that are conglomerates. I mean, they could have businesses that absolutely have nothing to do with
Right.
each other. And the reality of the rule is, the building, the part of the business that's doing X can collect tax on the part of the business that's doing Y that have no connection at all other than joint ownership.
Yeah, and I found interesting, Calum, that effectively this can be collected under any means necessary. So whether it's potential denial of deductions, imputation of income.
Yeah, I mean, if you go back to the model rules, it talked about, the denial of deductions or an equivalent economic measure. There are provisions in there that say, look, if you don't have enough deductions to deny, then the liability gets carried forward and keeps being collected every year. In the commentary, they expanded on that and said, well, you don't have to deny deductions. You could just raise an income assessment. And, at least the wording of the commentary implies that you could raise an income assessment more than the deductions you would have otherwise denied. So it's an unclear mechanism. But basically the idea is, the very clear idea is that somehow, some way, this top-up tax will be collected every year in every multinational enterprise.
Yeah, and in Biden's proposal for fiscal year 23 in the Green Book, I did find it interesting in the Green Book that the mechanism that at least Treasury would be proposing would be to deny deductions to the extent that you're subject to the UTPR, effectively putting a company in a gross taxation position. So They weren't going to impute any additional income beyond what you would otherwise be in a gross income, but then you have to carry forward, any of that under-tax payment into future years.
Which is the same as the model. I mean, the Green Book, pretty faithfully followed the proposal in the model rules.
Exactly. What does this mean? So I want to touch on this for tax treaties. Do you any insights or thoughts?
You've got to look at this and say, well, two things. One is, from the OECD perspective and the inclusive framework perspective, their view is 137 countries signed off on this. And so as far as they're concerned, there is broad political agreement. And so, their starting point is, well, everyone agreed to this, you'll make this work somehow. Now, the reality is that there are bilateral tax treaties out there, and there are other agreements out there that countries are going to need to be able to negotiate and navigate their way through those in applying these rules. If you look at the Pillar 2 sort of framework, there are three ways that this tax could be collected. One is an income inclusion regime. The other is that countries adopt a qualifying domestic minimum top-up tax regime. And then the third is UTPR. And they all have different analysis as to how that fits in with the current international framework, how it fits in with things like credibility under US FTC rules, how it fits in with treaties. I think it's fair to say that the biggest tension in all of this is the UTPR. It's very odd in international tax framework for a country to levy tax without any connection to the profits on which they are levying the tax on. That doesn't fit neatly into your normal standard tax treaty. That talks about taxing rights by reference to profits that are attributable to that jurisdiction, either in a permanent establishment context or in a subsidiary context, but they're all framed by reference to these are the profits that this country is entitled to tax. And no treaty anticipates a country taxing something that has nothing to do with it. And that's going to be a real challenge to work through how that applies. Now, obviously, in some cases, there won't be a treaty that's relevant. But in a lot of cases, there are treaties that are going to be very relevant, and it's going to be interesting to see how that plays out.
And whether they may consider a multilateral instrument.
That may be an approach. I mean, the OECD, if you go back in time to the blueprint, a year ago, they were very certain that treaties did not need to be changed to apply the rules at that time. But you've got to remember that commentary, that statement, was based on the previous undertax payment rule, where there was connectivity between the levying of tax and the low taxed income. They haven't revised that comment other than to say we don't think treaties need to be changed for the new framework with this wider UTPR.
Yeah, I view this as this will be fascinating, both from an academic and then an actual
Right.
how does this get implemented
But I think the message for companies is, unless something happens very quickly, this framework will start to be implemented by countries, and then you're in a discussion around, can I litigate that under normal litigation process, which turns out is a long period of time and a level of uncertainty, which really multinationals and I think governments would be best served trying to avoid the need to litigate these points and actually get it right up front.
I agree with that. All right, so want to move on to talking about some of the tax attributes and the complications associated. Were there any changes to the provisions on booking down tax attributes to the minimum tax rate? And that's in Article 4. And I think the thing that surprised a lot of us, or maybe offended is the right word, is the possibility of a top-up tax in a year when there is no income.
Right. There's no change in the commentary. The commentary, reinforces the model rules that, two things. One is that deferred taxes under the Pillar 2 rules are calculated at the lower of the statutory rate of that jurisdiction and 15%. So that is enshrined in the commentary and in the examples that came with the commentary. So that was, made more certain that's their position. Now, it's hard to really get to grips with why that is the answer they've chosen. I mean, it appears to be based on a paranoia that somehow companies will use deferred tax accounting to shelter low tax income. I think that is a misunderstanding of how deferred taxes work, but we are where we are. So we've got this 15% cap in there. That is confirmed by the commentary. The commentary also confirms that a top-up tax can apply in the year of zero income or indeed in the year of making a loss. It's a mechanical calculation which comes up with an analysis whereby if you've got a loss in a year for book purposes or for globe purposes, and the loss is different for tax purposes because of preferences under the tax system, then there is a top-up tax to be collected. Now, there's an election in the rules that allows you to effectively elect out of that top-up tax and defer it until the years in which you start actually using the loss. But either way, it's still, mathematically, and I think for US GAAP financial statement purposes, you're going to have to provide that liability in some form or other.
Right. All right, so the commentary also provides a specific example of a tax credit equivalent to a portion of the tax paid under the IIR to be used against other taxes as being a condition that would prevent a regime from being regarded as a qualified IR. What did we learn about whether a tax regime is a qualified IR?
Well, we didn't learn a huge amount other than it set out the framework that the IIR should be a standalone tax burden. You can't use other attributes to relieve the IIR. If someone introduces a rule that says you can use other attributes, then by definition under the model rules and the commentary, that would no longer be a qualified IIR. It doesn't really say what happens then, but obviously what does happen then is that to the extent that the appropriate amount of top-up tax has not been collected and it's not a qualifying IR, then you fall back on the rest of the rules, the UTPR, et cetera, et cetera. So we didn't learn an awful lot around what it takes to be qualifying. There's talk in the commentary around setting the criteria by which something will be judged to be a qualifying IR. And, the reality is, this is going to take the implementation framework to provide some guidance as to what happens if country A thinks that country B's regime is a qualifying IR, but country C comes along and says we don't agree. What is the mechanism for everyone agreeing that a regime qualifies or not? There doesn't seem to be any clarity on that at all, which
right. And it appears
is very concerning.
It is very concerning, and it appears that we're going to need to do a separate assessment for every country,
Right.
and then who is the judge and the jury on those. And I think we also got some guidance from the EU that they're going to try to centralize that.
Yeah, I mean, the EU obviously is in a different position than the OECD. I mean, the OECD, you have to remember the OECD doesn't have any executive authority. They set out guidance, guidelines. They ask countries to then follow those guidelines. The EU is much more of an executive authority. So the EU can, as a conglomerate, if they can agree, set rules whereby these rules can be applied. And within the directive, they set out not the rules as to determine what is an IR, but the criteria by which they would judge whether a regime is a qualifying IR. So they didn't set out this is what you require. They just said these are the sorts of things we're going to look at, and we will decide whether something is a qualifying IR. And let's not kid ourselves, that is entirely focused on whether the US system is compliant or not.
Yeah, which I want to come to, but just as one final point on that, I mean, what could happen is that various jurisdictions could take different positions on what's a qualifying IR or not, is my concern.
Well, that's clearly what could happen. That's not the way the rules are constructed. The rules are constructed with a very happy thought that everyone will be able to read these things and agree exactly how it's interpreted, and there will be a 100% consistent interpretation across all jurisdictions. I think that's a ambitious and somewhat laudable aim, but the reality is I can't imagine that's going to be straightforward.
Right. So let's go back to this. So what does this mean for the US GILTI regime and our subpart F? We have blending currently.
Right.
Who knows what's going to happen with country by country GILTI and potential US tax legislation as we progress here in 2022. But what are your thoughts of GILTI, both with respect to when we currently have blending or if we move to a country by country GILTI regime?
Well, I think, way back last year, the OECD talking points were, if we're going to do this, we have to find a way for GILTI to coexist alongside whatever we're designing. There was a recognition that actually the US had gone first with some sort of minimum tax regime. It wasn't the same as was being written by the OECD, but it was the framework on which a lot of this was based, at least the policy objective. In the last year, we've seen very much a drift away from that, whereby there is a broad sentiment supported at some level by statements from US Treasury and the administration that says that the current GILTI system does not work the same way as the Pillar 2 system because it's on a blended basis. Obviously, the proposals in the Build Back Better, the proposals in that was to go to a country by country GILTI. That looks more like Pillar 2, but it is recognized and acknowledged and known that the tax base that's being taxed under GILTI is under US tax principles. The tax base that's being picked up under Pillar 2 is something else. It's not another thing.
Base.
It's its own creation, but it can be very different than the US base. And I think that's now becoming a concern as to, well, how do we make a GILTI, even if it's on country by country, be able to sit alongside comfortably a Pillar 2 regime. And for US multinationals, what that means is a huge difference between a compliance burden and a potential tax exposure, between if GILTI is seen to be a compliant IR regime, that will relieve a huge amount of burden. But if it's not seen to be totally compliant and there's a need to do two sets of calculations, then that is a huge burden for all US companies.
Right, and then I think there's also uncertainty if it is not considered compliant to the extent that the U.S. is assessing tax on these CFCs, whether it's under GILTI or subpart F, where, how are those taxes in the...
Well, I think the subpart F analysis is relatively straightforward. I mean, you can identify the income that causes subpart F and the jurisdiction from which that income came. And so if the US is imposing a tax burden, it's not that hard to see how you allocate that tax back down to the jurisdiction in most cases. Now, the other side to that, of course, is subpart F is an inclusion that goes into a basket that has a bunch of other stuff in it.
Right.
And so you've got to work through those sort of issues as well. GILTI on an aggregate basis at the moment is a more complicated analysis. I mean, in most companies' GILTI calculation, there's the inclusion, there's the blending, there's the tested losses that may offset it, there's an inclusion percentage that is defined by a whole bunch of other rules, there's QI, there's credits from other jurisdictions, and then over the top of that, even when you get the income inclusion in the US, under the current rules, there's then expense allocation.
Right.
How do I allocate those things back down to individual territories in a system that is designed to be an aggregate system? It's not designed to be an individual. Now, I think there are mechanisms that can be used, but the problem is that what I think is irrelevant. It's what each country thinks is an appropriate mechanism.
Right.
Or a centralized view from the OECD inclusive framework as to how this could be done.
So let's move on to another issue, which I think is acute for U.S. multinationals, but frankly relevant for anybody, and it relates to the qualified refundable tax credit. So the commentary expands on that definition and clearly articulates the disparate treatment of qualified versus non-qualified tax credits.
Right.
Can you talk a little bit about that? Why is that important? And then we can talk about what are some examples in the U.S.
Well, I mean, it's important only in that that's the definition they've decided to use, and there is clearly a disparate treatment between a tax credit that is a qualified and one that's not qualified. And so the basic concept is, if you've got a qualified tax credit, refundable tax credit, then that is not accounted for as a reduction in tax, but is accounted for as effectively an income item. It does affect the effective tax rate as an income item, but nowhere near in the same way as it does if it's treated as a tax credit and denied. I think the definition was somewhat arbitrary insofar as they picked a definition that said, if you get a tax credit, if it's refundable without reference to using it against a tax burden within 4 years, then we're going to treat it as income. But if not, then we're going to treat it as a reduction in your tax liability and a preference that will be picked up under Pillar 2. It's actually not that dissimilar from how US GAAP and indeed IFRS treats those regimes. I mean, generally speaking, if you've got a refundable credit, it shouldn't really be accounted for through the tax line. Now, people may put it through the tax line, but under GAAP, probably it should be treated the way that the OECD are recommending, which is it's an income item at that point in time.
Yeah, I think what's been interesting to me as we've done this analysis for a number of taxpayers is that these non-refundable type tax credits can cause a jurisdiction that might otherwise have a high statutory rate,
right.
and the U.S. is an example, or higher than the 15%, that as a result of these certain non-refundable credits, it can cause a company for their globe tax rate to be below 15. Can you give some examples in the U.S.?
Well, the U.S. is uniquely placed to suffer from this issue insofar as the U.S. tax system is largely based on a full inclusion system with a tax rate that clearly is above 15%, even after TCJA. I mean, it's 21% federal plus state, which normally gets to 24, 25%. But the US Congress over years, many, many years, has chosen to incentivize companies to behave in certain ways by giving them credit regimes. And whether that's the R&D credit regime, whether it's low-income housing, whether it's green investments. FDII. There's a whole host of provisions in the US tax system, more than probably any other jurisdiction in the world, where the incentive for companies to do things is enshrined in some form of credit system, none of which are refundable credits as currently designed. And so for US companies doing the calculations required under Pillar 2, all of those credit systems, or FDII, which isn't a credit but is a deduction system, all of those are dilutive on the US effective tax rate. And what I think has been probably the biggest surprise since December the 20th, when these rules were dropped, is just how many US companies are drifting either very close to 15% or below 15% as a result of how the US tax framework is designed.
Right, and to remind listeners that this is relevant for both foreign non-US parented companies as well as US parented companies, because to the extent that the US globe rate is below 15%, then foreign subsidiaries of the US could collectively collect that top-up tax from the US.
There is no relief just because you're a US parent.
And I'm pretty certain that those are not going to be creditable foreign taxes.
I am certain under the current foreign tax credit regs as finalized in December, they would not be creditable.
Precisely. All right, so let's move on to transfer pricing adjustments. So the commentary specifies that when transfer pricing adjustments are needed, and this is in Article 3.2.3, when doing calculations, so that there needs to be adjustments in the current year as well as prior periods, and uncertainty with unilateral and multilateral adjustments. Can you talk a little bit about that?
Yeah, I think this is an area that merits some further clarification. I don't think the commentary clarified very much, other than to say, yes, transfer pricing can apply to these calculations. I mean, if you go back to the model rules, what the model rules said was, everything needs to be done on an arm's length basis. And there was real concern at that point in time that meant, for every company, you had to examine every entry on a trial balance and say, well, does that reflect an arm's length principle? That was a scary concept. I think the commentary narrows it to say, look, no, what we're trying to do here is say, if you've got a financial statement number, and for some reason the taxing authorities think there is a different number that should be taxed under the arm's length principle, and those adjustments are made, then we should reflect that in the globe calculation. And at that level, it makes sense. In other words, they're trying to determine a minimum tax by reference to what tax you're paying. And if the tax numbers are very different than the financial statement numbers because of transfer pricing adjustments, it kind of makes economic sense to have an adjustment. The problem is that the mechanism by which they've done it is to say, well, you should adjust. The problem is that in the real world, often your transfer pricing adjustments follow 5, 6, 7, 8 years of discussions with taxing authorities.
Yeah, over a variety of periods.
Over periods. You then get into treaty analysis with competent authority. And the way the rules work is to say, well, if something changes, you should go back and adjust your numbers. Well, you could be going back 3, 4, 5 years and adjusting numbers which you filed and everyone's paid the tax on, and suddenly you've got to go back and say, well, I need to adjust these numbers. There is no mechanism in the model rules to get a refund of the top-up tax. No one's talked about that in the model rule. It just talks about you're going to pay your top-up tax. Oh, and by the way, if after the event you realize you haven't paid enough, you should pay more top-up tax. There isn't a mechanism that says, well, if you paid too much, this is how you get the money back. And clearly transfer pricing adjustments
go both ways.
Right. I mean, that's the concept of transfer pricing, is it adjusts both sides of a transaction. So there's no mechanism there. So I think that is definitely one for the implementation framework to think about actually how you're going to administer that, and then how are you going to actually work through those numbers in real life.
So there were over 50 pages of examples that were released as part of the commentary. Was there Any highlights or lowlights or insightful things that we should take away from some of those examples?
I guess the question is, how are you spelling insightful? Is it meant to be making me angry, or is it meant to be making me more learned? Yeah, the examples are kind of as expected at some level. I mean, I was saying before we got the examples, the problem with the OECD examples is they always take a black and white fact scenario and provide an example. The problem is we don't operate in the world of black and white, we operate in the world of grey, and it's very hard to extrapolate the easy fact examples to the hard fact real life. So I don't think there was much in there that was a surprise to anybody as to how the rules are operating. There's a few examples where the example is giving an outcome which I'm not clear is obvious from the wording of the model rules, but it didn't necessarily cause any real surprise and didn't really move the discussion forward very much. They did a good job saying this is how the rule operates in this fact profile. They don't explain how it works in a more complicated fact profile.
Right. Yeah, one of the examples that I found of interest was related to when there were minority shareholders.
Yeah.
And how that can change the economics with respect to how the IR and the UTPR work. Can you briefly just highlight that so that listeners are aware?
Yeah, I mean, the way the rules work is, if you're a US, a multinational enterprise and you are the majority owner of a joint venture, the rules are set up to say, well, everyone should share equally in the burden of a top-up tax in a joint ownership, but only if certain fact profiles are met, which is that the joint venture entity has implemented the relevant rules. If they haven't, then mechanically the way the rules work is you could end up, if you're a 55% owner of a joint venture with a third party owning the other 45%, you could end up in a situation where economically you bear 100% of the burden of the top-up tax, and the 45% joint venture party has no economic cost at all. And that, to me, is a very wrong answer. I mean, people enter into joint ventures with an economic agreement as to how they're going to share, costs and profit, and now we've got a set of rules that say, well, for this particular cost, top-up tax, we're going to write a rule that says you don't necessarily share it equally, and that can't be right, in my view, as to exist. Now, clearly, going forward, you will be able to write joint venture agreements that make clear that the economics will be reshared however they're going to be shared.
Absolutely.
But that doesn't solve the problem for existing arrangements.
Well, and I think that's the point, is that assuming that some of these rules get enacted in a jurisdiction, that it's really important for companies that are thinking about JVs to start because we would have never have thought about this, obviously, before these particular rules, and it could significantly change the economics.
Right.
So, as I mentioned, the rules are not enacted in a jurisdiction yet, but we're currently in a period where certain transactions taxpayers do today could be significantly impacted by the rules. And so the JVs are one example, but also any type of deals and transactions.
Right.
And so maybe we'll start with an asset deal. What should taxpayers be mindful of in the context of a cross-border or even a within-country asset deal?
Well, a true asset deal, and when I say a true asset deal, that's an asset deal that's really an asset deal.
Yeah, not a check the box, check
not
and
some
sell.
fiction of
Right.
US tax.
Right.
A true asset deal is relatively benign under these rules because you're getting the same treatment economically and for tax and for Pillar 2. You've acquired assets. Everyone agrees that you've acquired assets. I mean, there could be a debate as to how you allocate the purchase price over those assets, but broadly speaking, it gives you a relatively straightforward answer as to what the attributes are. It does give rise to some challenges on a go-forward basis insofar as, if I buy assets under a legal construct, but for US GAAP purposes, some of those assets may be indefinite life assets, Some of them may not be. I need to know the classification of those assets to then determine how my future covered taxes under Pillar 2 will apply, and they can give very different answers between an asset I buy that I decide is indefinite life under US GAAP and an asset I buy that I think is depreciable, amortizable under US GAAP, gives a very different Pillar 2 answer. So, but largely asset deals are the sort of known.
Right.
It may give you problems, but you know what those problems are.
What about stock deals?
That's where we get into more fun. Stock deals come in all shapes and sizes, and the US tax system again is a little unique as compared to other jurisdictions in that things that are legally stock deals for US tax purposes may be seen as asset deals. So, if I buy the shares in an LLC, legally that's a stock deal, and for financial statement purposes that's probably reflected as the purchase of the members' interests of an LLC. For US tax purposes, generally an LLC is disregarded, and so for US tax you think you've bought the assets. The difference between those two treatments and how you play that out through Pillar 2 is causing major disruption to the treatment of those deals. Obviously, the US also has a 338 provision which says, well, even when I actually do buy stock, in certain circumstances, I can make an election to treat that as an asset deal for US tax purposes. Again, the US tax system is somewhat unique in that regard, and it departs massively from the framework which Pillar 2 thinks it's dealing with. And as soon as you depart from that framework, you have the potential for getting fairly odd results. And I think where we're working through at the moment is, in the circumstances in which you make a deal in the US and you decide to do it with a 338 election, or you decide to buy assets, or you buy an LLC, what does that do to your Pillar 2 calculation going forward? And the real problem is that there isn't an easy answer. It's not like, well, in all cases you should do an asset deal. It's what are the facts and circumstances, and what is the profile of the taxpayer to determine what the treatment would be under Pillar 2. And I don't think that really is a system that makes a huge amount of sense, whereby, I'm doing an economic deal and somehow the way I do that deal is giving me massively different answers on what's supposed to be a level playing field under Pillar 2.
Right, and I think this has probably warranted its own separate podcast, just unpacking some of these deal implications, particularly related to stock deals. So stay tuned to the Cross-Border Tax Talks podcast for more on that. So I did want to move now from the commentary from the OECD to the European Union. And the European Commission released its draft of the EU minimum tax directive shortly after the OECD released their model rules. And we touched on this briefly in our prior podcast. So there's been quite a bit of news out of Europe on this, including the fact that Poland does not support Pillar 2 unless directly tied to Pillar 1. And Poland has, obviously a lot on its plate dealing with Ukrainian refugees. So the first question is, does this mean Pillar 2 is dead in Europe?
No. Short answer, no. I mean, Poland is making a very legitimate point, which is that this whole package was sold by the OECD as a package, with Pillar 1 and Pillar 2 both being part of that package. And somewhere along the way, they got bifurcated. And somewhere along the way, it became clear that Pillar 2 was easier to push forward without Pillar 1, and so the things got separated. And Poland are making the legitimate point that that wasn't what the agreement originally envisaged, and therefore they feel they have the right and the obligation to say, well, these things got separated somewhere, but that wasn't the deal we all signed up to. Now, everyone can debate why Poland's doing that. Have they got other motives, et cetera, et cetera. But the statement they're making is a fair statement, which is this whole thing was designed as a combined package. And if you don't do Pillar 1, then Pillar 2 needs to be thought through very carefully. And that's all they're saying at some level.
So we appear to have Pillar 2 wobbling a bit, if you will, in the EU.
Well, it's only wobbling by reference to the EU being the mechanism by which it's implemented. There is nothing to stop member states of the EU writing domestic legislation to enact Pillar 2, providing what they write is compliant with the EU law and the freedoms of establishment, movement of capital, et cetera. Countries can do that. There's no doubt they can do that. The preferred route in the EU, for obvious reasons, is to do that through a directive, which was what was proposed. The problem with the directive is it requires unanimity. That requires all 27 member states to agree to what's being in that directive. And as long as one, in this case Poland, says, no, I don't agree, then they can't do it unanimously. At some point, either Poland will be persuaded that actually they should agree, or countries will turn around and say, well, if we can't do it through the EU mechanism, we then need to think about whether we do it through our domestic legislation, which is not, it's not banned. Countries have forever in the EU implemented their own tax laws. It's just a question as to, can you make those tax laws compliant with the EU law? And then you've got, there's a lot of countries that aren't in the EU. Everyone talks about the EU as being most important in this, but
you remind me that the UK is not part of the EU anymore.
The UK had a vote and they left. The UK is not part of it. The UK is going through a consultation process at the moment to implement these rules with an effective date that's a little later than the OECD recommendation. Instead of 1st of January 23 and 1st of January 24, it's 1st of April 23 and 1st of April 24. That's, there's reasons behind that under how the UK system works, but the other way I look at it is there's a very strong race to be second on implementing these rules.
Yeah, and we've seen a number of other jurisdictions that have also talked about implementing these rules. Australia, Canada, Japan, South Korea. So what are your views kind of here in closing on overall timing?
I always thought 1st of January 23 and 1st of January 24 was unlikely to play out in real life. There's a huge amount of work to be done by individual countries to implement these rules, and that is kind of predicated on the fact that if you're going to try and implement these rules, what you're trying to implement needs to be relatively clear, and we don't have clear rules at the moment. The OECD can say we've issued model rules and we've got the commentary, but the fact that myself and a bunch of other people around the world are looking at those rules and still trying to work out what on earth they mean is probably a good indication that they're not that clear. And we've got to get the implementation framework. That is being talked about as late in this year. Late in this year in OECD terms normally means at best sometime really late in this year, and often means actually, well, we didn't get it done this year, sorry. And then we got countries saying we're going to implement the rules from 1st of January 23 without the implementation framework being available. I tend to believe that's going to drift. The EU have effectively acknowledged, in order to try and get everyone on board, that they've effectively delayed it by a year. I think other countries will follow suit. Everyone at the moment, there's the politics behind saying, we're on board, we signed up to this, we're going to do this 1st of January 23. And then there's the reality when you get people involved who actually understand the complexity of what you're trying to do, saying, well, you know what, it may not be smart to implement this badly. We may be better to implement it with appropriate thought and timing. So my guess is we will see a drift from 1/1/23 to some later date. But that doesn't stop a country actually deciding, no, we're still going to go 1/1/23 and enacting rules.
Right.
And the framework of the rules is it only takes one country to implement these rules and they start potentially having effect for every multinational.
Right, and then that one jurisdiction could, under the undertax payment rule, could collect all of that income. And so what I have said is it just takes that first domino to fall, and I think all of, other jurisdictions will follow.
And I think that's definitely true. I think there is, as I say, I think there's a strong desire to be a really strong second on this from the countries. But if one country goes, then other countries are likely to follow suit pretty quickly.
And we'll certainly have you back to discuss on the Cross-Border Tax Talks podcast. Calum, always insightful. Thank you very much for joining today.
Okay, pleasure.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Calum Dewar, PwC's Integrated Global Structuring Leader. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.